What is going on, guys? I am so excited to give you an overview into the book Flash Boys. Before we start, there's going to be a full timeline in the description in case you want to go back. Please listen until the end to get the full experience. Even if you're not watching the screen, please just listen. This is going to be a deep dive with a ton of information into the inner workings of the market and how average people like you and me are getting screwed every single day with this undefeated strategy of investing. So 30 slides, I promise you from start to finish, they're all going to be informative. Please stay for the end and let's begin. So humans versus computers. Before 2007, the speed which a trader could execute had human limits. So humans worked on the floor of the exchanges. If you wanted to buy or sell anything, you had to pass through them. After 2007, it was just simply stacks of computers in a data center, and the speed was no longer constrained by people. In 2002, 85% of all market orders happened on the New York Stock Exchange and the NASDAQ, which were processed by humans. The issue with this was during the 1987 crash, Wall Street brokers, to avoid having to buy stock, just simply stopped answering the phones. So what did that do? It screwed people like me and you who had no way of going into the open market. They were calling the brokers to try and sell their positions. They were ignoring them. So everyone got destroyed. Okay. In response, the government regulators had to mandate the correction of electronic small order execution system, which is now us able to trade electronically from our iPhones, laptops, anywhere on the go. Makes it very easy and convenient. Dark pools. I know everyone wants to know about dark pools. They are private stock exchanges run by big brokers, and they were not required to reveal to the public what happened inside of them. They reported any trade they executed, but they did with such significant delay, it was impossible to know exactly what was happening in the broader market at the moment the trade occurred. So this could be days or even possibly weeks of delays. It will give us little to no insight, and we'll go a little bit deeper into that. But the internal rules were a mystery, and only the broker who ran the dark pool knew for sure whose buy and sell orders were allowed inside of them. Okay, the amazing idea that Wall Street banks sold retail investors that transparency was their enemy on the public exchange was comical because their data would be flashed publicly, but the same exact thing is happening just to a select group of billionaires or huge banks. Okay, they're doing the same exact thing, but they're just restricting it to everyone else. So they're getting all the food just for a tight group of guys. So same exact concept, just manipulating us mentally. What they were supposed to be used for. Okay, dark pools are not a bad thing. I know we see this all the time. Ban dark pools, ban naked shorting. That's not the case. If they're used properly, which is to facilitate block trading by institutional investors that didn't want to impact the market with large orders, okay, that is why I believe that they are a good tool. They're just being abused right now. So say a big firm, BlackRock or Vanguard, wants to buy 30 million shares of a company. If they went into the open market where we trade and dropped the 30 million clip of shares, whether it's a buy or a sell, that's going to have a huge impact on the price and especially have a huge volatility factor. Dark pool data. So they wanted to boost the volumes in the dark pools. That's why they're taking a lot of our orders and routing them there. The statistics used to measure the performance was a little more than screwy. So the stock market was judged by the volume and the average trading side. So the more volume and the larger the average trading side, the better it was deemed for the investor. So New York Stock Exchange sent IEX a record of 26 small trades, but then reported it as one single 15 share block order. So again, when it comes to data, it's their own self-generated stats. Every bank is ranking themselves number one. And it's just the industry that over glorifies data because the data is so easy to game and the true data is so hard to obtain. I want to say that again. The true data is so hard to obtain. We know that when it comes to any sort of mainstream media telling us about global news. And we can go on for days about how, the true data is so hard to obtain.
So in the equity markets right now, if you place a market order, a retail market order, 95% do not go to the lit exchanges, do not go to NASDAQ or New York Stock Exchange, they go to wholesalers. Basically, a lot of our market right now is dark. It's not in the lit markets, David. It's dark and going to wholesalers and how we get more transparency and competition in the market. So
you heard Chairman Gensler talk about 90 to 95% of the orders are going to the dark pools. They're not going to lit exchanges. So he also talked about payment for order flow, another incentive. Basically, in 2010, every American stockbroker and all online brokers effectively auctioned their customer stock market orders. TD Ameritrade was paid hundreds of millions of dollars each year to send orders to high frequency traders, including one called Citadel, which execute a large number of orders on TDA's behalf. It was so insidious because you just simply couldn't see it happening. You know, a penny, fractions of a penny here and there, you have no idea. And people are getting screwed because they can't imagine a microsecond. I mean, fractions of a second, tenths of a time it takes for you to blink your eyes. It happens so quick and no one sees it happening. Bernie Madoff, American fraudster and financier who ran the largest Ponzi scheme in history, $64.8 billion, was at once the chairman of the NASDAQ Stock Exchange. He advanced in electronic platforms and the concept of payment for order flow, which is described as a legal kickback. I mean, guys, it's so crazy how people don't see how this could be a problem. 3 activities that led to grotesquely unfair trading. This is where you have to pay attention. So this is the electronic front running. Okay, so they are able to see an investor trying to do something, and then they're racing him to the next. Okay, and we'll give you an example in a moment. Rebate arbitrage. So using this complexity to gain the seizing of whatever kickbacks the exchange offered without actually having to provide the liquidity that the kickback was meant to entice. Third, slow market arbitrage, which occurred when a high frequency trader was able to see the price of a stock change on one exchange, pick off orders sitting on the other before it was actually able to react. So here's the example of how this works. So say, for instance, the market for P&G shares is $80 to $80.01. Buyers and sellers sit on both sides of the exchanges. A big seller comes in and knocks the price down from $79.98 to $79.99. High frequency traders are going to slap the ask, buy it at $79.99, and then before it changes on the other exchange from 80 to 79, they're going to flip it right back to the markets for $80. Okay, so that happens all in a microsecond, that 1 or 2 penny change before the market officially changes. Again, their computers and their software and technology is way more advanced than the exchanges. So this happens all day, every day, and generates billions of dollars a year than other strategies combined. All 3 predatory strategies depended on speed. So let's say you know something before everyone else. You're in a very privileged state. So how is this legal? Well, Regulatory National Market System, or Reg NMS, was passed by the SEC in 2005, but not implemented until 2007. This is the problem, is it required brokers to find the best market price. Okay, this has been inspired by charges of front running in 2004 that had to settle on a $241 million fine. A little bit of history. To define best price, they relied on the concept of the national best bid and offer, which we know as the NBBO. Here's the problem. It mandated routing to more exchanges than you otherwise might have to go to. So it created more opportunities for people to front run you, and it made it easier for high frequency traders to predict where brokers would exchange that offered best market price. Okay, so just going back for a moment, okay, again, now that there's multiple exchanges, so not all of those exchanges are going to have the technology that these high frequency traders have. So say there's 3 exchanges and the price goes from 80 to 79.99. Now, it might be on a 1 or 2 second delay before those exchanges actually update that price from 80 to 79.99. The high frequency trading firms come in, swoop in, buy it for a penny lower, and sell it back to that same exchange or however many exchanges offer the highest price before their slower systems update on the new price, which they already bought it and resold it for before that even changes. So that is why it created more opportunities from the front run you because they have to legally look for multiple exchanges. So they were just looking for who would offer me the highest price, buy it for as cheap as possible, and flip it before their slow systems updated that price in real time. Okay, so the NBBO, or the National Best Bid, compiles all the bids and offers for the stocks in one place. Okay, that place inside of a computer was called the Securities Information Processor, SIP. The 13 stock markets put all their prices into the SIP and calculated the NBBO. So they put all the orders in there in the Securities Information Processor, and then it calculated the national best bid. Okay, the SIP was the picture of the US stock market most investors saw. So this is how they exploit the retail investors. The period of time between the moment the order was submitted and executed was gold to traders with faster connections. So the gap in time between the real price and the real price and the private one. So the public SIP, which is what we see on our screens, versus the number they see. Again, our systems are on a 1 or 2 second delay, and we're talking about fractions of seconds in terms of speed that they have. So my screen might say 80, their screen might say 79.98. Okay, they just have in real time the right price, and we have a slightly delayed price. But again, the delay is so slight and so insignificant to us that it doesn't really matter. But to them, the greater the stock price bounced around, the greater the gap in time, the more chance the stock price would bounce, the more likely a fast trader could stick an investor with an old price. And that is the key. That's why volatility was so valuable to high frequency traders. It created new prices for faster traders to see first and then exploit. So a little study that was done in February 2013, a team of researchers at Cal Berkeley showed the SIP price and the prices seen by traders with faster channels differed 55,000 times in one single day. So this is key. So the SIP price is what we see, and then the price seen by traders, that differed over 55,000 times in a single day. This was over 9 years ago. So this meant 55,000 times a day a high frequency trader could exploit the wider market. 55,000 times a day, a trader might buy Apple shares at an outdated price, turn around and sell them a new higher price, exploiting the ignorance of a slow-footed investor. This is an undefeated trading strategy. In 2005, a quarter of all trades in the public stock markets were made by high-frequency trading firms. By 2008, it was 65%. In early 2013, Virtue publicly boasted 5.5 years of trading. It experienced one day it hadn't made money, and that was a human error. Dave Cummings, CEO of high-frequency trading firm TradeBot, told his university students his firm went 4 years without a single day of trading losses. This is not possible unless you have a huge informational advantage, an unfair advantage. By the middle of 2011, roughly 30% of all stock market orders occurred off the public exchanges in the dark pools. We know that from 2011 to 2021 or 2022, 10 years later, 30%, now up 60, 65% to 90 or 95% of all retail orders are not going to the lit exchanges. That is a huge increase. That is absolutely ridiculous. Bernie Madoff pioneered the idea of paying brokers the right to execute the orders, which should have told people something, but apparently did not. So how the hell does this all work? Let's talk about gaming for a second. Anyone that's a computer or console gamer will easily understand this, and we'll make it a little user-friendly. So latency, you're testing your internet connection essentially. Let's say one person has their router hardwired right next to their console, right next to their computer. They're going to have a great connection, no interference on the signal. Let's say the other person has their router in their basement and they're on the second floor. Okay, there's going to be a lot of disturbance. They're going to have to go through wireless connection. Okay, so that is obviously going to be much different. So latency, simply the time between the moment a signal was sent and when it was received. Okay, and there's several factors that determine latency. So there's going to be the boxes, the logic, and the lines. So the boxes is the hardware or the machinery that the signals pass through from point A to point B. So the computer servers and signal amplifiers and switches. So it's the hardware. The logic is the software or the code of instructions that operates the box. So again, the codes within the machines. And third, the lines or glass fiber optic cables that carry information from one box to another. Look at Verizon, for example. They run cable through fiber optics. Very similar. Okay. So again, the biggest determinant of speed was the length of the fiber and the distance of the signal needed to travel to get from point A to point B. So the biggest enemy of speed of the signal was the distance. Physics is physics, and that's what traders just don't understand. So like I said, imagine you have your router all the way at the opposite end of your house compared to someone who has it right next to them. That speed is going to be much faster because the distance is much shorter. Same exact thing works for high frequency trading. Feds working for high frequency trading firms. This is where it gets funny. So Royal Bank of Canada conducted a private study never released publicly and found 200 SEC staffers since 2007 left their government jobs to work for high frequency trading firms that lobbied Washington on their behalf. These people played central roles in deciding how or whether to even regulate these high frequency trading firms. So the people writing, proposing, and trying to implement or not implement these bills and regulations know everything about it and now are leaving their government jobs and going to the firms that they're choosing not to regulate. Okay, knowing that they're exploiting people. In June 2010, Associate Director of the SEC Division of Trading and Markets, Elizabeth King, quit her job at the SEC to go and work for GetGo. Absolutely ridiculous. Types of orders that are suspect. So this is where things get a little, gray. It's sometimes hard for people to understand this, even for me a little bit. So we'll take it slow here. But BATS is an exchange. They created an order type for more complicated reasons, allowed the high frequency trading firms to withdraw the order or pull it back if a large percentage of it was about to be executed. So hide not slide is the order type. It's a way for high frequency traders to cut in line ahead of people who created the line in the first place and take the kickback. So exchanges offer incentives and kickbacks to trade within their market. So what they're going to do is trying to take that kickback or take that incentive that they get paid for trading in the exchange without actually executing the order. So they submit the order, get the fee or get the kickback that they want, and then they withdraw the order, taking that fee without actually putting up the liquidity. That's the simple way of explaining it. But they were designed to create an edge for high frequency trading firms at the expense of the investor. So most of the order types were designed not to trade or discourage trading. Okay, so what they want to do is obtain information as cheaply and as riskily as possible. So that's when you see the ping ponging. Go look at the level twos and you'll see the bid and the ask. There'll be, let's say, 100 or 1,000 or 1,500 block orders going back and forth that are below the bid and ask. And what they're doing is they're submitting the order, withdrawing the order, submitting it, and they're pinging. They're trying to gain information without actually having to front or put up that liquidity. Okay. And the reason why this is true and real is that they made only half of the trades in the US stock market. So they're only submitting half of those trades, but they're executing more than 99% of all the orders. So they're, again, executing nearly 100% of all the market orders, but they're withdrawing or pulling back half of them and only submitting 50%. So that's important. Big name players, please don't get discouraged, guys. There were huge name people we're about to talk about that had no idea what was going on. Okay. Citadel Derivatives, or Citadel, was easily one of the smartest and one of the biggest high frequency trading firms. I believe that Citadel and Ken Griffin took Bernie Madoff's version of payment for order flow and was able to manifest it into this brilliant legal way of stealing from people every single day. Okay. He's very, very smart. Citadel has always been the leader in terms of high frequency trading technology since the mid 2000s. They've been around. So the most sophisticated investors did not know what was going on in their own market. Not Fidelity, not tZERO Price, not Janus Capital, not even David Eisenhorn. Okay. And they were so shocked because prominent hedge fund manager Bill Ackman of Pershing Square suspected people might be using information about his block trades ahead of time. It was like there was a leak every time. I thought maybe it was a prime broker. It wasn't the kind of leak I thought. So again, even guys who or fund managers had billions of dollars or hundreds of millions of dollars in assets under management, not but 8-9 years ago, had no idea that this was happening in their own markets, no idea that they were being front run, had no idea that there was arbitrage occurring. So this is certainly an incredible learning experience. Don't be discouraged in any way. It's just very hard to prove that any broker dealer is routing the trade someplace else other than the place that's best for you. So again, you click your order, you click submit, you have no idea where it goes. You have no idea what your broker is doing with it. You can't prove it. They could tell you, oh, you clicked route to New York Stock Exchange and it went there. You don't know for 100% fact it went there. You can check the level twos, but again, that is the problem, is it's very hard to prove. And you couldn't see what any given broker was doing. If an investor as large as tZERO Price, who acted on millions of small investors, was unable to obtain from its stockbrokers the information it needed to determine if the broker is actually acting in their best interest, what chance did we have? So if tZERO Price and Fidelity and Bill Ackman cannot get their stockbrokers information to determine if they're acting in their best interest, how are we going to do it? We're not. So that's the point, is that they know what they're doing. They know exactly the questions you're asking, but they're playing dumb and not trying to give you any real clarity. This is a very secretive business. And this is probably the most important part of the video as we get into the last half of it. And if you guys are sticking around, amazing, because this is where it's really going to be the icing on the cake. So how did this all happen? So they negotiated. Chris Nagy was a salesman for TD Ameritrade. He sold the order flow, and most of the deals were handshake deals. You go down for a steak dinner, we'll pay you 2 cents a share. Everything is good. Okay. The negotiations were always done face to face. No one ever wanted to leave a paper trail. Payment for order flow was off the record as possible. Okay, they never had an email, never had a phone call. You had to fly down and meet with us in a restaurant or in a nice luxury place. Okay, buried inside the income statements, payment per share on a line labeled other revenue. So you could see the income, but you can never see the deals. Okay, please understand, this is a secretive, lucrative, very shady business. No one wants to leave a paper trail. No one wants to document anything. That's a problem. Okay, TD Ameritrade was able to sell the right to execute its customers' orders to high-frequency trading firms for hundreds of millions of dollars a year. The biggest, Schwab, whose order flow was even more valuable than TDA, sold its flow to UBS in 2005 for an 8-year, only $285 million. Now, that is only because it was much more valuable. They actually got a bad deal on that. They could have charged probably double. But still, back in 2005, nearly 15 years ago, still hundreds of millions of dollars for this information. Imagine what it's worth now. Programmers were clueless. So a lot of these programmers, very, very smart guys, they're mostly Russian. That is typically where the elites or the cream of the crop comes from, these programmers. They never fully grasped the connection between their work and the traders. And a lot of them were for Goldman, they talk about in the book. They were minimal connections between people. And as Goldman says, some components broken, we're losing money because of it. Fix it now. That's it. Fix it now. However you got to do it, do it. The programmers were assigned to fix the codes. They sat in cubicles. They hardly spoke to one another. Okay. The markets were now run by technology, but the technologists were still treated like tools. No one ever bothered to explain business to them, but they were forced to adapt to the high demands and exposed to its failures, which is perhaps why so many more failures occurred, is that they were just fixing something that they had no idea how it operated or why it operated. And that's why there was a lot of failures. And we'll talk about the flash crash in a moment. But the NASDAQ business guys then, when the system busted, blamed the tech guys for the failure, and the tech guys all wound up with this abused animal quality to them. So it's really horrible the way that they were treated. They were never actually informed as to what codes that they were writing and what it was for and how it was being used to game the public. They were just, kind of like slaves. Don't talk to anyone, don't confide with anyone, just do your job, fix this problem. And there was always problems that needed to be fixed. So all about IEX, which is Investors Exchange. Okay, they are a new exchange that cut off the food source for all predators. Okay, the fiber routes through New Jersey that were handpicked so that any order sent from IEX and the other exchanges arrived exactly at the same time. So this is what we were talking about when we were talking about gaming or testing our latency. We want to obviously have the best latency, but when it comes to trading in high frequency firms, being faster is how you win. So IEX made it possible that they had a specific delay, and we'll go into that in a moment, but it allowed an even playing field so that everyone would arrive at the same exact time. There would be no people that had a jump start in the foot race or had a speed advantage. The slow movement of dark pools had made it possible for high frequency traders or Wall Street banks owned traders to exploit the orders inside it legally. They needed to be extremely fast, much faster than any other exchange. At the same time, they were slowing down everyone else who was trading on the exchange and speeding themselves up. So that's what IEX did. It wanted to have a speed advantage over everyone else and keep them sort of on a level below them where everyone was on that same playing field and they sort of oversaw how everything was operating. Okay, all fiber was created for high frequency all fiber used was created by high frequency trading firms for high frequency trading firms, 100% of it. And they had a 350 microsecond delay, which worked like a head start in the foot race. So they made sure everyone was delayed besides them. They were faster, and so that they were able to see and react to the wider market, even as the high frequency trading firms were. So again, the biggest thing that we have to take away from it is that they created a 350-second microsecond delay, and they also needed to keep the exchange roughly 38 miles from the place the brokers were allowed to connect their exchange. So they didn't allow anyone to put their systems right next to the exchange or have a distance advantage. So speed, everyone is on a 350-second delay. I know I repeated that 3 times, but that's important. So in terms of speed and then distance, so 38 miles from the place the brokers were allowed to connect their exchange. That was important. Okay, so what they did was they coiled the fiber. So instead of running straight fiber cables between 2 places, they coiled 38 miles of fiber and sticked it in a compartment-sized shoebox to stimulate the effects of distance. Okay, so from a high frequency trader's point of view, it is like they have been banished to West Babylon, New York. So creating fairness was remarkably simple. They would not sell to any one trader or investor the right to put his computer next to the new exchange or special access to the data. They would pay no kickbacks to the brokers or banks that sent the orders. Instead, they charge both sides of any trade the same amount, 9/100ths of a cent or 9 mils. They didn't allow anyone who can trade directly on it to own any piece of it. Okay. Hello, tZERO. 3 order types allowed: market order, limit order, midpoint peg. The investor's order rested between the current bid and offer of the stock price, kind of like the midpoint. So if it was between 40 and 40.02, 40.01 would be that midpoint. So IEX incentives. Traders on IEX were also 4 times more likely than those elsewhere to trade the midpoint of the current market bid and offer, which most would agree is the fair price. Okay, that's important. You want to create a system where behaving correctly would be rewarded, and the system has been doing the opposite. Okay, it's rational for brokers to behave badly because they're supporting the bad behavior. Okay, the reader might question the characterization of small time skimming and scalping, but a penny here, a penny there adds up in more extraordinary ways in the US stock market. Dark pool arbitrage accounted for over $1 billion a year. It was just one single trading strategy. A billion here, a billion there, it adds up. IEX statistics: 92% of orders traded at the midpoint are fair price compared to the 17% that traded at the midpoint in Wall Street's dark pools, and the public exchanges were even lower. So you think you're getting best price fill in the public exchanges? Wrong. You think you're getting that even in the dark pools? No way. So 92% compared to 17% or less in the open markets, certainly a very nice statistic there. The trust had been rewarded, and to function properly, the financial market did not need to be rigged in someone's favor. It didn't need the sick kickbacks or the payment for order flow or co-location of other sorts of unfair advantages handed to a small handful of traders. So again, IEX proved that you don't need to have a speed or distance advantage. You don't have to, game and have all these kickbacks in order to operate effectively and efficiently. So the flash crash, what everyone wants to know about. The book is titled Flash Boys. Well, then came the so-called flash crash in 2:45 on May 6, 2010. For no obvious reason, the market fell 600 points in a few minutes. A few minutes later, it bounced right back to where it was before, as if you weren't paying attention, could have easily missed it. Shares of Accenture traded for a penny, while shares of Hewlett Packard or HP traded for more than $100,000. That's ridiculous. No one could say for sure what caused the flash crash. For the same reason, no one could prove that the high frequency traders were front running orders of in ordinary investors. So the data just didn't exist. Okay, there was no way to prove it, no reason for why it happened, but it was probably just due to another system failure and just having your lab rats or programmers just constantly fix or repair junk. It's like putting a band-aid on a gunshot wound. Eventually you have to operate, you have to rebuild it. You can't just keep patching it. You have to take the bullet out, and you have to really fix the issue, not just cover it up. Red flags: the fact that it is such an opaque industry should be alarming. The fact that the people who make the most money want the least clarity possible, that should be alarming too. How could you give a mortgage loan with no documentation? It's preposterous, but banks did it. And now trillions of dollars of trades are being executed on the markets where no one has any idea of how it works because there's no documentation. Does it sound familiar? It's a facade. The markets are interconnected. So why this will never be fixed? Really, it's brilliant what they have done within the bounds of regulation. They are much less the villain than I thought. The system has let down the investor. It's like a broken slot machine at the casino that pays every time. It would keep paying off until someone said something about it, but no one who played the slot machine had any interest in pointing out that it was broken. The same system gave us subprime mortgage, collateralized debt obligations, or CDOs. No investor could possibly truly understand, and now gave us US stock market trades that occurred at fractions of a penny at unsafe speeds using order types no investor could truly understand. So if you made it this far, I want to say thank you guys so much. I really do appreciate it. I know it was a ton of information here. I hope you have enjoyed the video. Again, this is all legal, unfortunately. The system truly has let us down. I know I just said a lot. I don't know how long I've recorded for, but I do appreciate you guys sticking around and being here. This was by far one of the most informative books I've ever read, one of the best videos I've ever published. If you liked it, please drop a like, smash a like. Please share this video. It would really mean so much to me. And I know I don't beg for likes or comments or anything, but please just run this up for me as much as you can. I put a lot of time into this. So I hope that you guys have learned something. And as always, we'll see you in the next one.